Welcome back. Today we're going to consider two technical indicators. One you may have heard of, and one is one of our own creations. First off, it's the Bollinger Band percentage indicator. What it simply shows us is the percentage width between the Bollinger Bands, also taking into consideration the market's current closing price. This is how you'd actually calculate it if you choose to do so yourself. It's available on most charting applications as well. It's very simply the closing price minus lowest band divided by the entire range. And that represents the Bollinger Band percentage. It's a little bit different than the Bollinger Band width indicator, which is the range divided by the 20 simple moving average. Well, let's show you how it works. The red line over here is the 20 simple moving average. The black line is the S&P 500. The upper and lower blue bars, or bands I should say, are the Bollinger Bands. They're standard 2 standard deviation 20 simple moving average calculations applied. The same as you'd find in any charting application. Now, the green histogram bars in the background represent the Bollinger Band width as a percentage. What it's showing us is the current percentage of its historical range, meaning calculating 2 standard deviations. How volatile is the market usually, and how volatile is the market right now compared to its historical average? So, for example, we can see we're going to March and early April of this year. The Bollinger Bands, the two blue lines, started to separate, indicating a greater degree of volatility. See, the black line, the S&P 500, rallied from lows near 3,800 up to highs near 4,100 in a relatively short amount of time. Well, the strong market created a lot of volatility. Now, the width of the Bollinger Bands expanded. That is reflected by this very tall green histogram bar, which shows us 106%. It's 106% of its historical average. Historical meaning it's calculated on a 20 simple moving average. Now, you'll notice when the market's in a tight trading range, the Bollinger Bands tend to gather rather close together, and the width drops. When the market becomes volatile and new trends break out like we've seen lately, or we can also go back to early January, take a look to see how strong the stock market was at that point. S&P 500 moves from 3,700 to almost 42 in a relatively short amount of time. Well, we cross from the lower band to the upper band. The bands start to separate from one another, indicating a greater degree of volatility, and the histogram bars rose as well. Right now, current time, we can see the Bollinger Band width indicator is at around 91%, a little bit below the average. We can see a rather tight range. Well, what does that all mean? First, let's consider the frequency. How often can we find the Bollinger Band percentage indicator at a given circumstance, meaning at what percentage? Well, remember, right now we're at 91%. Well, from the 90 to 91 percentile, that occurs, and this goes back several decades. This is one of the more popular, or more common, I should say, instances. It's about 288 times over the past several decades we've seen the Bollinger Band width indicator register that level. However, the most common, about 50%, well, about 30% more than that, is the Bollinger Band width indicator on 80%. After that, 70%. After that, 60%. So the vast majority of the time, we're going to see the Bollinger Band width indicator between the 60 to, I'd say, 90 percentile. Anything above 90 or below 60 is certainly less common. Now take a look at the Bollinger Band width indicator. This time it's shown in the black background. The white line is the S&P 500. This goes back to May of last year. Now, if you remember, the market started to get kind of volatile because June represents the beginning of the inverted bond yield curve. We had a huge move to the downside. Now, in strong trending markets, the market will remain in a quite tight trading range. But when we start to see volatility, when we go from a very weak market to a very strong market, like this snapback, September, October, back to the upside, we see the width indicator rise. It's really the reversal. You see, before that, from June, we were strong and then weak. That reversal indicates a greater degree of volatility. And that's really where we see the highest readings on this indicator. Now, what does this all mean in terms of our performance, what we can expect? Well, we can calculate, and this goes back again several decades, so we have a good amount of data. We can calculate the average 20-day forward performance, meaning how does the S&P 500 act in the next 20 trading days moving forward. Now, we took the absolute value, meaning it doesn't matter if the market's going up or down. We just want to calculate how much can the market move. If the market's trending higher, we're looking for breakouts. If it's trending lower, we're looking for breakdowns. Well, the histogram bars here show us exactly what that performance looks like. In the 20 forward days, statistically speaking, when the Bollinger Band indicator is at a level of minus 10%, meaning a little bit below the average, we tend to see the best results, meaning when the market is in negative 20, negative 10, 10, and to positive 10, or 0 to positive 10, in this area, basically at the 0 level, the market's in a very tight trading range, and we can expect breakouts. See, that's when breakouts usually happen in the market after it gets very, very quiet. Conversely, when the market is very volatile and we see the Bollinger Band width indicator around the 90-100% level, the forward expected performance of the S&P 500, again, it's not directional, either up or down. How much can we expect the market to move? Not very much, only about 2.3% on average. So statistically speaking, when the market's at the level where it is now, it actually indicates it's in a very quiet range, and it'll probably stay in a quiet range. However, when the market gets so quiet that the Bollinger Band width indicator really drops, that's when we really expect the breakouts. So again, take a look at the white line, the S&P 500. When we hit lows of September, October of last year, take a look at the black histogram, the black area chart, I should say. That's the Bollinger Band width indicator. It was very, very low, and look what happened afterwards. The S&P 500 broke out to new highs. Conversely, the market moved higher, and then this band expanded. And then after a while, it started to fall into a trading range. We didn't come all the way back down. The S&P 500 only retraced about 50%. So point being, if we're looking for a breakout, we want to see the Bollinger Band width indicator near the 0 level. When we see it as it is right now, near the 70, 80, 100% level, we expect quiet markets. And those quiet markets will persist until this indicator drops. Statistically speaking, that's what we've seen. Now, another indicator we're going to look at, and this is one of our own creations, is the calendar look back indicator. Very simply, it counts a number of days we have to look back in order to see a higher high or lower low. You ever wonder, well, the market's making a new high. Well, how much of a high? How far back in time do we have to look to see the market making a higher high or maybe a lower low? Well, we can see here, and this chart goes back to 2020. This is the S&P 500 in white. The blue histogram bars show us when we have a breakout, when the market breaks out to the upside, how far back do we have to look to see a higher high? Conversely, when we see the red histogram bars, we have to look back to see how far back do we have to look in time to see a lower low. Well, take a look at, for example, the market hit a very significant low. This is March of 2022. S&P 500 drops down to around 4170. That was after hitting highs near the 4800 level. Well, this red histogram bar pops down to a level of minus 187, meaning we have to look back 187 days in time to see the market trading at a lower low. And we can see that took place. Now, again, that was March of 2022. We have to go all the way back to May of 2021. The reason why this is important is because the longer we have to look back in time, the more of a potential breakout or breakdown will ensue. Simply put, when the market breaks down to new lows, and lows we haven't seen in 187 days, it means everybody that bought the stock market over the past 187 days, as soon as we register a new low, they're probably or most likely losing money in any open positions. Conversely, anybody who sold short the market during this 187 days, all of a sudden their trading accounts are positive and their statements are profitable. So the longer we have to look back in time, the more significant it is. Now you'll notice we hit these lows and then we pop back up. The market does have support and resistance. It won't always very just cleanly break down. But we can see the break of a double bottom, which is a pretty important principle in technical analysis, that we have the double bottom over here. And again, that's S&P 500 around 4170. The second time we broke, we really broke. We broke from 4170 down to 3900, almost 200 points in the S&P 500. Now, we broke down to very significant lows around 3586. That was September of last year. We hit the double bottom. But the failure of the break in the double bottom actually indicates a very strong support. See, the double bottoms and double tops are very important indicators. When you break the double bottom, it's most likely we're going to go a lot lower. But when we test and fail to break below the double bottom, that shows us how strong it really is. Now, currently, we can see the S&P 500 close at a level today, 4169. This blue histogram bar shows us we're at a 62-day high. 62 days minus today puts us back at a level early February. Now, this might be a double top. If we break out to new highs, those highs are on 4180. Let's take a large round figure, let's say 4200. If we see the S&P 500, let's say, fall back down a little and then make a second attempt and break above and register a 4200 print, that could be very conducive of a further move to the upside. But if we hit the double top and then reverse to the downside, that might show us that we have a pretty solid resistance up there. So it's certainly something to take in consideration. And also keep in mind, we hit the last time we hit these highs, it was February, early February of this year. That was a 116-day high. So point being is that this level is actually pretty important for the S&P 500, although lately it feels like it hasn't really had a strong trend. Maybe we're at the beginning of something new. Putting these two indicators together, the look back, our breakout, breakdown, look back indicator shows us we're in a trading range. We're testing pretty significant highs. We're not breaking out yet, certainly not yet, but we're at the level where we should be paying attention. But conversely, the Bollinger Band percentage indicator is telling us that we're around a 70-80% level, and that typically does not produce great results as far as a follow-through, as far as a trend is concerned. Of course, the indicators only show us what the market has done. They don't predict the future. They just tell us statistically what the tendencies are. So we have to watch this very closely. But both indicators, I think, are telling us that the 4,200 level, it's a pretty significant level for the S&P 500. If we see the market above that, especially with heavy volume, then it's probably conducive of a follow-through to the upside. But if not, I'm sure there's going to be orders to sell short right up here, anticipating a reversal back to the downside. We'll revisit this indicator on a regular basis and update you along the way with any significant developments. We hope this has been helpful. We look forward to seeing you back soon.